Welcome everyone to the 911 real estate call. Whether you're a doctor, managing patients,
a business owner, running operations, or an entrepreneur balancing multiple ventures, this space is designed for you.
multifamily real estate investing can seem overwhelming,
But today, we're here to make it simple and easy to understand. Together, we'll dive into real deals, discuss strategies, and exchange ideas to help you grow your portfolio and generate true wealth.
This call isn't just about properties, it's about building strong connections and creating long-term financial success.
Let's jump in and unlock the next step in your investment journey.
So we got our guest of honor today, and Jaideep Balekar. I want to take a moment to introduce Jay, that he's not only a respected partner of mine, but also a friend as well. Jay and I first met back in 2002, partner on deals, share stages at events in Cincinnati. And from personal experience, I can say that Jay commits to something when he does. He goes all the way and he does it right. And he's the kind of guy with integrity at his core, someone you can count on 100%, whether it's in business or in life. And if he ever ran for office, I'll vouch for him without hesitation, Jay, just so you know. Now, professionally, Jay is the principal at Prosper Capital, where he's built and managed a high-quality multifamily portfolio, over 550 units. His track record spans landlord-friendly markets, in-house operations, vertical integration, which we love. And he focuses on systems. And now, before making his mark in real estate, Jay spent nearly a decade in cybersecurity consulting with big firms. And beyond just the titles and the deals, he stands out most is his character. He shows up, follows through, inspires others. So please help me welcome my friend, partner, and a true professional, Mr. Jay Balekar. Here we go.
Well, thank you so much, Alex. Thank you for that introduction. I'm super humbled. Thank you, both of you, Alex and Eric, for keeping this going, by the way. I mean, it's really difficult to be consistent. And now this call has been going for over 2 years, and I've seen the participation improve. And it's just awesome to see you all Saturday mornings. I can't make it to every call because I'll talk a little bit about buying businesses on the call today as well, and pros and cons. So that's one of the reasons I end up missing a lot of these calls. But really awesome to be here. And thank you for all of your support. This is mostly all MIH family here on the calls. And, through this whole journey, I've met some incredible people. So thank you all for all of your support. So I think today when Alex and Eric asked me to, be on this call, I was thinking about what should I talk about? Because I'm always talking about multifamily. So I don't know if I can talk about something new when it comes to multifamily. So I thought about, the other thing that's extremely hot these days is buying businesses. And I did buy one, or started one, in 2023, and have some definite lessons learned from that journey as well. So I wanted to talk about that as well, because oftentimes what you see on Instagram Reels and Cody Sanchez YouTube videos is not the whole story. They're telling you what gets the clicks and the views. They're not telling you the other side. And I'm not being a Debbie Downer. It can have a huge potential to create wealth for you and your family, but you have to be cognizant of the other side. And so that was one of the topics I thought would be helpful for people, as more and more people are looking to buy businesses. And then, of course, we can't end this without talking about multifamily. So I'll be talking a little bit about multifamily too. So with that, I'll kick this off, and I'll try to stay within an hour, but I might go over. So hopefully that's okay, Alex and Eric.
Hey, it's all good.
It's all good.
All right. Cool. So let me start presenting my screen here. Let me know if the full screen is on and not the presenter view.
You're on.
Yep, you're on. Mm-hmm.
Cool. So agenda, I'm going to tell you a little bit about me. Most people on the call, we are friends already, but if there's anyone new, just a quick intro about me. Then a comparison between starting a business versus buying a business. And then how does that all compare to multifamily real estate investing and real estate investing in general? what are today's changing market conditions when it comes to multifamily real estate? And then based on those changing market conditions, what is our strategy for 2025 and 2026? Now, that strategy is our strategy, may not be the right strategy for everyone. It's applicable in the Midwestern markets where we operate, but hopefully you get some key takeaways from that as well if you're an active multifamily investor. And then finally, I'll open this up for Q&A. So I was born in India, moved to the US when I was 17, moved to Texas. I still remember my perception of the US was that everything in the US is very cold. So I had 5 jackets on when I landed in Houston in August. And that's when I realized that this was actually hotter than India. So that was my first introduction to Texas, but had a blast in Texas. I was there for 4 years at Texas A&M, college town. So had not much to do besides spending some time in the labs. Harshad was actually my roommate. So he did electrical engineering at Texas A&M, and I was going there for computer science. And we were roommates for 3 years. And now we are partners on many deals. So, it's a full circle. So it's just an amazing feeling. Then I moved to Cincinnati for grad school. And that was perhaps the best decision of my life, because I met my wife, Lisa, in grad school. And I have been happily married since 2015. And she's my partner number 1 in real estate. And I never thought I would get married when I was 25. I thought I'd get married by like 35 or so. But everything happens for a good reason. We got married early, bought a home immediately, and, started building wealth together, much earlier in life than I thought. So every single decision in your life has a huge impact. And sometimes those decisions are not intentional, but good things happen. And then you see compounding returns of those decisions in your life later on in your life. And one of those decisions for sure is marrying the right person and, your life partner and your partner number 1 in any venture that you do. I worked as a cybersecurity consultant for about a decade with Deloitte. It was a travel job. I absolutely loved my job. It was not that I got into real estate because I hated every day of my job, but I got into real estate because I was reading all of these investing books during my travel to client sites every week. But I didn't get started until 2019. So I'd spent about 2 years reading all these books, but didn't take action because I was always out. And then late 2019, I finally bought my first 8 unit. And I dove directly into multifamily because I had read about multifamily versus single family and stuff like that. And I was convinced on the benefits of multifamily. Bought 8 unit, gut job, not knowing how much work is involved. And thankfully, blessing in disguise, my travel stopped because of COVID. I know it was an unfortunate event for a lot of people. A lot of people lost their jobs and lives. But I got to stay back in Cincinnati for 2 years and really expedite my real estate journey. I just kind of fell in love with the whole process of real estate investing. So it comes from like really hunting for deals, closing on the deal, then really, completely flipping the property, the before and after transformation, putting good quality people in. And then eventually I could start to see its value in creating long-term freedom for me and my family. And that was the time when cash out refis were very easy or relatively easy to do. Interest rates were low, appraisals were coming in high. It was a great time, right? We all missed that time, I'm sure. So all of these deals, we were getting 120% cash out return, all the money you invested back and 5 times more in some cases. I was like, wow, this stuff, why didn't I find out about this stuff early? But anything that's too good to be true indeed is too good to be true, and it's not sustainable. So times definitely have changed. Market is a lot more uncertain, and we'll be talking about that here towards the tail end of this presentation. I founded Compounding Capital Group in 2020 after leaving my job in 2023 because it came to a point where I could either do justice to my investors or to my employer. I was stuck in Zoom calls all day when I was at my W-2 with my clients. And I did not have time to do broker meetings or talk to my investors. So I had to make that decision. And I didn't want to get fired from my firm. I wanted to leave on a good note and not burn that bridge. So, if it's all gloom and doom and recession and I have to go back to my job, at least I keep that door open. And that was my thought at the time. I don't think that's going to happen. But that was my thought at the time. So founded Compounding Capital Group in 2020 and then joined MIH Mastermind in June of 2021. Actually found Yosef's post on Bigger Pockets, and I saw all the progress he had made. So I hopped on a call with him. And I was just amazed, not just by his progress, but immediately just by who he was as a person. And since then, Yosef has become a dear friend. And then Yosef introduced me to Marco and Hadar and MIH Mastermind. And hands down, the best decision that I've made, because that was one group where everybody felt like family from the get-go. And now it truly indeed has become a family. I find every opportunity to hang out with this group. And this was one group which was very different from other groups where I was not taught just go big or go home, buy 150 units. Anyways, it's other people's money. So this group did not teach me to play around with other people's money. This group taught start small, learn from your mistakes, and then slowly scale up. And I think that was the message that I truly aligned with and gravitated towards. And now even today, I mean, we stay very connected with all the new people coming into MIH, and I try to do my best to kind of give back and just stay in touch with this group. Left my job, like I said, in 2023, became a full-time real estate investor. But then I also started a franchise business in 2023. And the whole point was to supplement my real estate income with this business income. Because as we all know, cash flow from real estate takes a long time to build. And although this concept sounds great in theory, there are some pros and cons, because time is the only asset that you have that is truly limited. So when you make decisions like that, you have to think about how much time you have. And we will be talking a lot about that in some of our upcoming slides about buying a business, starting a business versus multifamily. And then finally, merged with Prosper Capital in 2024. My partners at Prosper Capital are Andy and DJ, and we are fully vertically integrated through this merger. DJ had focused a lot of his time and energy in building a really good property management company. And that was something that I was missing. I was relying on third-party management, and some of the people who have done deals with me, I think can attest to that I was trying my very best in making sure that I was fully present at the properties and managing the construction and stuff like that. But sometimes through this whole journey, I realized that having best intentions and your hard work alone is not enough. You need to have a whole team behind you, and everybody is doing their fair share and really taking care of their responsibilities. And vertical integration is extremely important when it comes to that, because property managers, we went through so many and none of them were working out. And we realized that we have to bring this in-house and we have to have the right partners to be able to do this. So since then, I think it's been one of the best decisions I've ever made. So our deals now are a lot more controlled. There's a lot less stress, a lot more predictable outcomes when it comes to NOI and results in terms of ROI on renovations and all of that stuff, right? So with that, I think I'll dive into some of the meaty stuff. So let's start with talking about starting a business and really comparing some of these wealth building vehicles. So I'm comparing starting a business, buying an existing business, and multifamily. So with starting a business, I think there are some key benefits, but at the same time, I didn't label this as pros and cons, because these are not really cons, but these are the things that you should watch out for. They could be cons depending on your personal life circumstances. So in terms of benefits, usually starting a business is less capital intensive. You can kind of bootstrap, as a quick example, you can buy a lawnmower and a truck and start a landscaping business. It's not going to take you a lot of capital to start it. Smaller loans, if any. Many times people start small businesses without any loans. But even if you have to take a loan, it's going to be a smaller loan. But it's going to be a little bit more difficult to take those loans. So you have to keep that in mind as well. You have more control, so freedom to make decisions, personal fulfillment. That is one of the key reasons people start businesses. So if you're not very happy in your current job, your boss is giving you a hard time and you are craving for that control and personal fulfillment and freedom to make your own decisions, that sometimes is a very big driver for people to start their own business. So starting your own business, of course, gives you that freedom. But you have to keep in mind that there is a lot of responsibility that comes with that freedom. So if you have hustle, creativity, problem-solving skills, grit, and ability to sell, because you are the first and only salesman you have when you're starting the business. And I think any business owner should have the ability to sell. And if you don't have that ability, it's a skill that you can learn. But at least these 5 you absolutely have to have. And this is not an exhaustive list. There's a lot of other qualities that I think you have to learn to start a successful business and operate a successful business. But you don't need to have deep pockets, and you don't need a PhD to start a business. So that's the good thing, right? You don't even need to go to a college to start a successful business. And you have unlimited upside potential. So when you're starting a small business, you're starting it small with limited capital, and in 20 years, you can grow it to a scale where it can become a multi-billion-dollar corporation. I was watching this YouTube channel, I think it's called School of Hard Knocks, where this guy goes and interviews people who have made it. Some advice for the young crowd. What did you do to be successful? And one of the guys on that interview was the guy who started Cane's Chicken. And you may think it's a private equity owned company with franchise model, but it's not. The guy actually owns pretty much 100% of that company and is worth close to $18 billion. Who would have thought Cane's Chicken founder is worth $18 billion? So, but he started this company like almost 20 plus years ago and made sure that he retained equity so he could make decisions that were good for the business rather than decisions that private equity made on his behalf that were good for a 5-year exit. So with a short-term view in mind. And he's built truly an empire. So you have that upside potential when you start building a small business. And then there are, of course, tax benefits. So any small business or a business you buy or real estate is going to give you better tax benefits than your W-2 or even being self-employed. So all of these 3 vehicles are great for tax benefits. But now on the flip side, when it comes to starting a small business, what are some of the things that you should keep in mind? The failure rate of small businesses is extremely high. So 65 to 80% of small businesses fail, and over 90% of them are out of business within the first 10 years. So that is something you have to keep in mind. Now, you should not start a business with that in mind, that most of them fail. So I'm not going to start a business, because that's not a good mindset to start with. But again, depending on your personal situation, like if you have a lot of responsibilities and you have, kids and a family to take care of, are you in a position to take that financial risk? And if so, how long can you give yourself to take that risk? And if it doesn't work in that 1 to 2 years, do you have something to fall back on? Those are the things that you should be thinking about. Small businesses are hard to finance because there is no day one cash flow. You don't truly have an asset to finance. Any lender is going to look at collateral and cash flow in place to make sure they have decent comfort over that debt service coverage ratio. So you won't have that with small business. So you may have to rely on private capital, which can be expensive. It requires a laser sharp focus. So if you're trying to make this a side hustle, I would say think again. Now, that does not mean that side hustles don't work, but they can never become a true business that would create 6 and 7 figures in income. It can get you 20K, 30K, maybe you start a web development business on the side and stuff like that. But you cannot make a side hustle into a full scale business that generates 6 and 7 figures in profits for you while you still keep your W-2 job. You have to be truly focused. I saw a hand raised from Jonathan.
No,
Jonathan?
I'm sorry. It's the Zoom detected that I was like touching my face, so
Oh.
no hand, sorry.
Okay, no worries. And then need to build customer base from scratch. That's another one. You're starting a brand new business. I found that the hard way, that, man, building your customer base is incredibly difficult. 2 years, 1 to 2 years at the minimum, it's going to take to build that customer base where you start to see some recurring revenue. Otherwise, you will have a week or 2 every now and then where you have no work to keep your team busy. And now you're paying them out of your own pocket. Otherwise, they're going to leave you because A lot of times, any business that has, it doesn't matter what type of workers, white collar or blue collar workers, if you tell them, I'm not going to pay you for 2 weeks because we don't have work, they are immediately on Indeed looking for a new job, right? Because that's why they are in a job, because they want that assurity of income, and they don't want to worry about all the challenges that come with building a business. Finance, accounting, marketing, sales, production, delivery, networking, you just name it. These are just few examples, but every aspect of building that business is all on you, because you don't have a team yet. You're just building that business. So you have to focus on all of this, which means it's going to take a very high time commitment. This is going to be your baby, 9 to 5, evenings, weekends, no vacations. You got to be all in. And only if you do that, you at least have a chance, not a guarantee, to hopefully build a business that eventually becomes a sellable asset that you can eventually sell to private equity or to a family office or something. Or it can become your legacy, passed down to your future generations. But otherwise, it's not going to be truly an asset that you don't want to pass down to your future generations, because you're passing down headaches and not an asset. High stress. So initially, for the first few years, and actually sometimes even long term, business ownership is not for the faint of heart. It is going to give you high stress. But honestly, I think this is not something you can avoid. You just can get better dealing with the stress, but you cannot avoid stress. So I think there is no success without stress, right? You have to deal with stress if you are trying to pursue success, but it can have an impact on your physical and mental health. So that is one thing to keep in mind. And you have to start to get better with dealing with stress. With that, waking up early, putting your workout in, that's one improvement area for me. I'll be the first one to acknowledge that that's something that you have to focus on. Otherwise, you're burning your candle from both ends. You're working with an unproven business model or brand new idea, which you don't know if it's going to work or not. And the only thing that can save you with this is your faith. If you're faithful, where you can sell your idea to people, you're completely confident that idea could work. Airbnb, when that idea was pitched, most people thought it was stupid. Who's going to let other people, unknown people, crash on their couches? But look at Airbnb today, because the business owners were persistent. They kept selling that idea until they found someone who bought their idea, put an investment behind them, and look at that business today, right? So if you give up too quickly, that business is not going to work. And even if you're persistent, it may not work, because that idea indeed might be a dud. So you may have to start over again and again, 4 or 5 times, until finally you have a business that succeeds. So it's your first business. The chances of success are pretty low, and you have to at least be cognizant what the reality is. Again, I'm not trying to be a Debbie Downer, but you need to know what you're getting into. And then finally, lengthy exit cycle, 8 to 12 months to sell the business. So we often say that real estate, one of the downsides is lack of liquidity, or your capital is not liquid, it's stuck in a deal, so you cannot get to liquidity pretty quickly. Well, in business, it's even worse. Now, businesses, if they're cash flowing well, you're at least pulling in that cash flow. But if you want to sell the business, at least 8 to 12 months, and the business would be a little bit easier to sell if it's on the right track, where your revenues and NOI is going up. But if you get hit with a market cycle like now, and your revenues are coming down and profits are coming down, that business is not going to be very sellable during that time, because no one wants to catch a falling knife and buy a business where the revenues are declining, unless you're willing to let it go for peanuts, right? So those are some things to keep in mind when it comes to starting a new business. Now, how does that compare with buying an existing cash flowing business? I put cash flowing in the brackets because I would not recommend buying a business that's not cash flowing, which is called a turnaround type of business acquisition. Unless you have a track record of really improving and turning around 10 to 12 businesses, I wouldn't recommend buying a business that's failing. because you're still learning on how to manage a business, and you buy a failing business, it's going to be exponentially harder because the morale is low. The business, you're already losing customers. The reputation is tarnished, which you have to turn around. So that's something that I didn't even have a slide on because it's not for the faint of heart. I would personally avoid it until you become a seasoned business owner who has a history of ownership of multiple businesses. So buying a cash flowing business, which is also commonly called as entrepreneurship through acquisition, ETA, which has become a pretty common term these days. And this is kind of what Cody Sanchez or Walker Dybel, who's written a book called Buy Then Build, they all propose taking this route. And the success rate with this route is a lot higher. So 90+% of good businesses that people buy, and if you are a good qualified buyer, 90+% of them succeed. So much higher success rate than 65 to 80% failure rate with starting a new business, right? Now, these are easier to finance. Typically, the vehicle uses SBA loan because you can show day one cash flow. So based on that cash flow or SDE, seller discretionary earnings, SBA can give you up to 90% leverage. So you're coming out only 10% or so out of your own pocket. Now, SBA rules have also changed recently, so you need to kind of constantly see what those rules are. But the down payment is fairly minimal, and a lot of that down payment sometimes can be seller financed, either half of it or all of it. But again, SBA has changed some of the rules around there's at least some amount of capital that you have to put in from your own pocket. Usually a management team is in place when you're buying a business like this, which means you have people to rely on. And that means it can offer you a little bit more flexibility and lower time commitment. So you still have to be present. You have to be the first person to show up and the last person to leave, because you have to lead by example. And when a new buyer is coming in and the old seller is out, now you have to build your reputation with your team, and you have to be the hardest working employee so that your team works equally as hard, or at least 80 to 90% as hard. So it does not mean you have flexibility in terms of this is a passive investment or this is a absentee owner type of ordeal. You still have to be very much present. But can you take one vacation a year? Probably yes, in this type of a setup, right? Cash flow positive usually from day one. So usually if you buy a business for $5 million, you can expect 4 to 500K in cash flow net profit, out of which you can take 60 to 80% as your personal income and leave 20 to 40% back in the business. And then it comes with a proven business model and a proven market demand, because it's already an operational business. You already have an existing customer base. There's proven demand for this business. It's been around for 10, 20, sometimes 30 years. So at least you know that it's not going to completely stop tomorrow. It can be a great vehicle to generate cash, to invest in long-term assets like real estate. And that's really what we see. A lot of successful business owners make a lot of money through their business, and then they invest it in real estate for capital preservation, slow capital growth through compounding, and then the tax benefits they get through real estate as well, which they can use to offset some of their active income here through their business. So there is relatively quicker path to private equity exit. And I said relatively because you can't expect that in 2 years after acquisition, you're suddenly going to exponentially improve that business and sell it to private equity. You're still looking at least about 5 to 8 years to improve that business, to grow the revenue, to grow the NOI. And now you can sell it to private equity for a pretty good equity multiple, because you bought it potentially from a mom and pop seller and got a better price. And now private equity is willing to pay a better equity multiple for this improved business that is even more profitable. And then again, if that business has recurring revenue, for example, if it's a need-based business rather than a want-based business, you can get better equity multiple. Or if it's a SaaS business, software as a service, right? So you don't have to store inventory, you don't have massive machines that are producing some parts and tools and stuff like that. you are getting even as high as 8 to 10x equity multiples. So the type of business you buy is also going to drive what type of equity multiple you're going to get. If you have a solid management team, including a CEO, a COO, and then all the managers, then you're going to get a much better equity multiple, as opposed to you still working in the business and the business actually relies on you. At that point, you probably can expect a 3x equity multiple. And when I'm talking about equity multiple, just for anyone who's kind of new to this terminology, because this terminology is kind of a little bit different from the multifamily language. The equity multiple is basically a multiple of EBITDA, which is your earnings before interest, taxes, your interest, taxes, and then your depreciation and amortization. Yeah. So essentially, very similar term to NOI in multifamily, but in multifamily, your NOI does include depreciation, amortization. It does not include your mortgage service, which is your essentially your amortization. It will be a part of your mortgage service. But essentially what it does, it's a true measure of profitability of your business, right? So you are paying, or the seller is paying an equity multiple of the profitability of the business. So that's how the businesses would get traded. So if you continue to improve your revenue, but your EBITDA kind of lingers at about the same price point, your business value is not really going up by much. But if your profitability is going up, of course, your business value is going up. And it does take time and effort to improve the profitability of the business. So relatively quicker path to exit, but still about 5 to 8 years minimum. So this is going to be a long-term ordeal. It's not something to generate quick profits, which oftentimes that's how it's portrayed on YouTube and social media. Oh, you just buy this laundromat and immediately you're collecting coins and I'm making 150K a year. Well, it's very difficult to do that with just one laundromat, for example. You need scale, you need systems, you need processes, you need a team to start truly seeing more predictable income. Now, what to watch out for when buying big businesses, right? Or relatively mid-sized businesses. When you're talking about a $5 million purchase and 90% of that is leveraged using an SBA loan, this is a full recourse loan. So if something doesn't go right, this could potentially put you into bankruptcy, because a full recourse loan means they can come after your personal assets, they can come after your homes, your cars, everything that you own, all of your personal assets. The only thing they cannot come after in bankruptcy is your retirement accounts, right? But anything else outside of that, that's going to be liquidated to pay for the bank loans, right? And typically people buying businesses are going to use SBA loan, and it's a high leverage loan. So high leverage comes with a pretty good amount of risk. So if you can buy a business with a lower leverage, that would be even better. And it's the same thing with real estate, 75 to 80% most. But if you're buying anything with 90, 95% leverage, it does increase your risk. And on top of that, it being full recourse loan with floating interest rate, by the way. So SBA loan typically is floating interest rate. So a lot of people who bought businesses in 2020 and 2021, they saw their interest rates double, just like we saw them double in real estate with bridge debt, right? So that's one thing to keep in mind. It's harder to find these deals that are already really profitable because private equity is chasing the same deals. And mind you, they're willing to pay more, because private equity manages hundreds of millions, billions in capital, and their targets to generate returns are sometimes a lot smaller than what your returns targets would be for yourself or for your investors. Potential liabilities is something to kind of keep in mind. Lawsuits, undisclosed debts. So if the seller signed kind of a sidebar deal with someone and took some debt that's not reflecting on your papers, that could be a potential issue. So you have to do a really thorough due diligence. DD with buying businesses can be really long-term, 90, 120 days even. So you have to do a really good job with catching all of these things to protect yourself. So that's something to keep in mind. Potential cultural and operational challenges, because a lot of these businesses are mom and pop owned. And the way the business operates is very much in line with the culture that has been set up by the owner. And a lot of times it's a culture where everybody's a friend, right? Everybody's hanging around with each other. And it's like more like everybody's a friend. We do all of this together. There's not a lot of, I wouldn't say that bureaucracy is necessarily great, but there's not a lot of structure and accountability enforced. And now you're suddenly coming in and you're trying to enforce strict standards and accountability, and that can cause some friction, at least initially. So you have to keep that in mind, that you're going to ruffle some feathers, and that could have an impact on your short-term profitability. You will lose some people. And sometimes that means you're just cutting the fat. The people who are not great, they're going to leave, and that's actually good for the business, but that does have an impact on your productivity and your profitability. So you have to keep that in mind. And there could be some operational challenges, just as I mentioned, impact on productivity. So have to keep that in mind. So you can't go in immediately thinking, I'm going to start pulling 300 grand a year from this business day one. You may want to have your own separate pool of funds that you can rely on, and not pull any money out of the business for the first 6 months to a year until you see how the business is operating. Another one is key man risk. And that's when the business overly relies on the previous owner, where all the knowledge and information is in this man's head and nothing's documented. There's no SOPs, there's no process documentation, and people don't know what they're doing. They're asking the owner every time they're doing something, and the owner leaves, you come in and nobody knows what they're doing. That's a really big risk. And oftentimes you see that when buying a small business. Any business that relies overly on personal brand. So for example, if you try to buy a YouTube channel, you try to buy Alex Hermosi's or Gary Vee's YouTube channel, and then Gary Vee is gone and your face shows up. Well, you can imagine what's going to happen to your subscribers. They're going to start dropping quick until you become equally as good as Gary Vee or better, and then you'll start bringing some of those subscribers back. But any brand that overly relies on the face of that person running the business before you, that's going to be a big risk. And then finally, lengthy exit cycle for this as well. So any business, you're going to have a really lengthy exit cycle. 8 to 12 months is average, but I've seen businesses not sell for 2 to 3 years. So you would have to be patient. So if you have a fire sale, family emergency, yeah, tough luck selling a business. It's not going to happen that quick. So with that, now I think
Hey,
the whole
Jay,
goal
before
with
you
those two
move forward,
slides.
Jay, if it's okay, I'd like to interrupt for just a moment, Jay. I'd like for us
Please go
to
ahead.
take a picture so
Yes.
that it can help promote you and your brand. All right. So
Should I
everyone
stop
turn.
sharing?
No, you're good. You're good.
Okay.
Yeah.
Cool.
All right, everybody, open up your cameras. Cameras on. Don't be shy. It helps us. It helps Jay. 3, 2, and 1. Awesome.
Awesome. Thanks, Alex.
Thank you.
Cool. So actually with that, let me take a pause and let me see if there are any questions. Maybe we can take 3 questions or so, and then we can also open it up for Q&A at the end. Any pressing questions that come to mind based on the
JD,
first 2?
I don't have any questions, Jaideep, but everything you're saying is so spot on. Like social media makes it sound like it's a cakewalk. You're just going to buy a laundromat and then go buy a Porsche. It is not the case. It's so much more risk involved, and the management has to. You are in this full time, or good luck. So thank you for. I think a lot of people need to hear this because I'm in the process
Yeah.
now, and it's very involved, and it's not easy, and also
Yeah.
the personal guarantee is such a huge thing, right? It's not a part of real estate investing when you're talking agency debt. So thank you for all that. Appreciate this presentation.
No, thank you for validating that, Sip. I know you're going through this process. You are already a business owner with Ryan Potak. So all of these things are real. And I learned all of this through experience. I wish someone would have told me this. And it's my fault. I should have joined a really good mastermind and got myself educated. But I've always been the guy who wants to try it out first and learn through doing things. That's what I did with multifamily. Thankfully, didn't get burnt on either of those, but there's definitely been a lot of learning. And I just wanted to kind of communicate that with some of the people who are now starting to think about buying businesses. So I'm glad to know it helps a lot of people. So thanks, Sip. Anyone else? Any questions, comments?
Hey, Jay,
Before
you
we keep rolling?
mentioned earlier
Mhm.
in one of your slides, you said you have to be good at finance, accounting, marketing, sales, productivity, delivery, people. Where'd you learn all that? And how do we develop skills like that?
Yeah. So, I mean, there are a lot of resources out there. For example, I was having a challenge with keeping my team motivated. So I read a book called The Carrot Principle, and the whole thing is about dangling a carrot, right? So it's a really good book where it talks about what motivates people and what motivates white collar workers, what motivates blue collar workers could be completely different. Because what I've seen is with blue collar workers, they want to see immediate returns. Like, okay, if they do a good job this week, there's a bonus by the end of the week. If I offer them equity in my business, it doesn't motivate them. But if it's your CEO, which is a white collar job, and you offer that CEO equity in your business based on performance, that is going to be very motivating for that person. So what rewards you offer could change. So that's just one of the examples I'm offering. But also the other thing was the business that I started was a franchise business. So franchise business comes with a little bit of training wheels where you have calls with your coaches. They teach you a little bit of sales, marketing. You're still on your own when it comes to operating your business, but there is a little bit of guidance. So if someone wants to start their first business, franchise may not be a bad idea, but once you realize that you are really good at running a business, then maybe you want to step away from the franchise model because you're paying fees and royalties in perpetuity. So they're taking a good chunk of your top line revenue for a long time. But to learn business, I think it could be a good opportunity as well. So there is going to be a lot of self-learning. And then if you get into like a good franchise system, they'll also do a little bit of hand holding for you. But there are also a lot of masterminds and consulting companies. So what like companies like McKinsey, Deloitte, all of these companies do for Fortune 500 and larger companies, there are similar companies that help small businesses, so consulting shops, and they will sit with you and develop your HR strategy. They will develop your marketing strategy and stuff like that and can help you through this. But then that is going to require capital, right? So you have to keep all of that in mind that if you need that help, you'll have to spend money for it, which means you have to be liquid enough to be able to do that and afford that help. So hope that answers the question.
I've
I
got a
know,
question,
I mean,
Jay.
Alex, you built your business yourself. So I'm sure you had to do a lot of self-learning. I mean, you've got a very successful medical practice. So,
A lot of self-learning for sure.
yep.
Thanks for sharing, Jay.
Mhm. There was one more question. Just heard someone.
Darren, I
Jay,
think
I've
you
got
had
a
a
question.
question.
Yeah, thank you. This is awesome. Really appreciate you, man. Incredibly grateful for your friendship and what you
Absolutely,
bring
Darren.
to everything. And it's been a pleasure to know you for a long time. This is my question. I have an opportunity to buy a small business, which is barely making it, but it's been in business for 40 years. And I can financially support the business to get it back on its feet without having to go get financing, this and that. Total mom and pop.
Mhm.
If I was to do that, and it just needs a bunch of marketing and continue doing more things in this class that it's not been doing because it was focused on one niche in the area. If we were able to do this, I'm asking you for suggestions on a structure, a basic structure. And we could have a sidebar conversation later about this, but just initially,
Mhm.
what are your thoughts on if we were to come in and do this, do we go 50-50? Do we do 60-40? And there's a family member involved as well. So
Mhm.
there's kind of the rub, but not necessarily in a bad way. I want to help this family member and support them moving forward and kind of carry on a legacy of who started this business, what have you. But at the same time, we could all benefit.
Yeah, no, that's a good question, Darren. And by the way, the feeling is mutual. I appreciate our friendship. You're a great person, and I'm happy to do a sidebar conversation with you and offer my, I guess, insights or suggestions. But my answer may not necessarily be the right answer for you, right? But I think here's what I think. So you said family member involved. That's your family member or the business owner's family member?
My sister's tied to the family member, so she's
Okay.
married into the family.
So I would say, yeah, when family is involved, it always can get complicated. It depends on how well you know this person. Can you trust that person? And if you're coming in trying to make some changes, would they be open to those changes? If they have the my way or the highway attitude, then it's going to cause a lot of friction. And number one reasons why most businesses fail is because of partnerships going wrong, actually. So that would definitely be something to be careful of. And then I would say that get a good expectation of how much time commitment you're going to need, almost like a time audit, and then see, is this worth putting your time in? And what does the pro forma look like? Like, okay, with some of the things that you can do to improve the operations, like marketing or improving overall operations, what does year 2 pro forma look like, or year 3 pro forma look like, and how soon can you be profitable, conservatively speaking? And if you can be profitable in 2 years, it's worth looking into. But if it's going to take a lot longer to get profitable, then very few people can be patient enough where you can actually continue to put a lot of time and energy into something that pays you peanuts for 3 years. It becomes very hard, right? So I think those are some of the things that come to my mind. And then if the business is kind of financeable currently, which it sounds like it may not be if it's not very profitable, and then what would be your kind of liquidity between you and your partner, that if the business continuously is capital hungry, where to improve it, you have to put in more and more money into the business? Do you have between you and your partner, or do you have another investor who can fund that? Those are some of the points that come to my mind, but there's quite a bit to consider. And you can always, like I said, like some of these consulting companies, you can also use their help, and some of them are really good, can offer really good insight, and they can even develop SOPs for you. So not everyone is very process oriented, and some people struggle with developing processes and standards, but they may be phenomenal with people. And then using some help like that can really help you with putting some of the processes and SOPs together. I'm just giving you an example that may not be your area, but any area where you do need help, you can use help. So all of these things come to my mind, but I'm happy to do a one-on-one with you, over a Zoom call.
Yeah, thank you. I'll get with you, man. I appreciate you.
Sure, absolutely, Darren. Cool. So now coming back to kind of comparing all of that to multifamily. So I think no one denies that multifamily is a pretty safe asset class, and that's one of the key reasons we all are in multifamily. We're not doing multifamily because it's easy. It's far from it. It's also operationally very intensive, but it is a very safe asset class because it's a basic human need. Everybody needs shelter over their head, and filling multifamily vacancy is going to be a lot easier than filling vacancy on your strip mall or office space, especially with office currently in this market cycle, right? It's easier to find financing on multifamily because there is land, there is a building, there is an intrinsic value that it has. And on top of that, if it's an existing asset with cash flow, then it's even easier. But many local banks will even finance a vacant multifamily building that cash flows zero, because at least they see there is a building, there's land, there's some value to it. So if they liquidate it, they'll get their collateral back, or their money back. So I think for me, that is the biggest thing to consider, is that it has intrinsic value. When you're comparing real estate with businesses, businesses do not have intrinsic value. Sure, you can liquidate your inventory and your equipment, but if you buy that business for 5 million and now you're selling it just for inventory and equipment, you're probably selling it for $500,000, right? So you could lose 90% of the business value if you don't run it well. But with multifamily, you could lose equity. So the investor capital raised, if you don't run it well, you could lose all of that. But at least you can pay the bank, even if you are the worst of the worst operator, typically, right? So which means at least they're not coming after your personal assets and stuff like that, even when it's a full recourse loan. So you do have to keep that in mind as to how much risk you're taking. Then it generates long-term wealth when, of course, when bought right, financed right, and managed right. If you overpay, if you use poor financing and don't manage it well, you could definitely lose your shirt no matter what you do, whether it's multifamily, whether it's buying a business, any business venture, you could lose your shirt if you're not operating it well and if you overpay for it. It does generate cash flow, although cash flow is slow. but it does generate cash flow. So that's a benefit. It's easier to sell, usually about a 2 to 4 month cycle. In a hot market, you can probably sell it even sooner. There's cash offers and whatnot. But even today, you could sell a multifamily property in about 2 to 4 months. And then there are tax benefits. So tax benefits with multifamily are depreciation and 1031 exchange. With businesses, typically it's only depreciation and some write-offs that you get with businesses. But 1031 exchange, definitely, as you all know, is unique to multifamily or real estate in general. Now, again, as we all know, all of these tax benefits, most of them are tax deferrals. These are not tax avoidance methods because you can't really avoid taxes, but it's just letting you defer those taxes. So for a lot of passive investors, the depreciation you get is going to get recaptured at sale, but you buy a new asset that year, use depreciation of that asset to offset the recapture from the one you sold. It still helps you play that game and continue to defer your taxes, or a good majority of those taxes, for as long as possible, right? So you're compounding your wealth pre-taxes, which is huge. So what are some of the things to watch out for in multifamily? It is definitely a game of patience. And that's a learning lesson for me, because one of the main reasons I started the other business was so that I can have some more cash flow that I can help supplement my real estate career, and maybe use some of that cash flow from the business to invest back into real estate. But like I said, it takes a long time, even with a business, to build a sustainable cash flow. And it's even more true with multifamily. When you buy a multifamily property, I hope you're all buying a property that cash flows day one. I wouldn't recommend buying a property that does not cash flow, but the cash flow can be very slim when you buy the property, especially in multifamily. If you're looking at industrial, you could have better cash flow day one. If you buy retail, probably better as well, because the cap rates are higher. But with multifamily, with it being a pretty hot asset, the cash flow is kind of slim when you buy the asset, usually 4 to 5%, 6% if you're lucky. It does require a lot of time and commitment and focus. So if you're an active investor, underwriting, deal sourcing, operations, asset management, investor relations, relationships with brokers and bankers and attorneys and CPAs, it's not a part-time job. It is a full-time job. So I think if you're trying to be a full-time real estate operator investor, you have to be ready to have pretty low cash flow and live on peanuts for a few years. And you're still putting your 100% of your time into this business for all of these things until you finally start to see some cash flow. Because as we all know, with any real estate syndication, most of your cash flow is going to go to investors first before you get anything. And you cannot really live on that cash flow. So you have to be cognizant of that. Management intensive just kind of goes back into that previous point as an active investor, and it is capital intensive as well, although getting capital in terms of bank loans is relatively easier. So this is going to be a quick slide because I think we're all pretty aware of this already. But if you're not, if you're new to multifamily investing, more than happy to jump on a one-on-one call. But to kind of sum this up, and we're almost at an hour, and I didn't even start talking about multifamily, so sorry about that. But just to kind of sum this up, things to consider when you're buying a business is, what is your current age? When are you starting out? What are your current responsibilities towards your family, towards your other people in your life, and your financial responsibilities? How much capital do you have? How much time do you have? And how much of that time and capital are you willing to risk? Are you considering return on time? Because a lot of times we, with our investor mindset, always look at return on investment, but we oftentimes forget to take a look at the return on time. And if you start a business venture that eats up all of your time, but gets you that return on investment 3 to 5 years from now, is that really worth it? Or are you in your life where time is the most important to you, right? So on the flip side, if you're starting out, if you're 20, 22 years old, maybe that return on time is not the most important thing for you. You just want to learn and get into it, and then slowly build something that eventually in 20, 30 years could be worth something much larger than you ever could have thought of or imagined, right? Is your goal to create risk-adjusted return, or do you want to take that go big or go home approach, right? So again, kind of ties back to that previous comment. Do you want to take an active versus passive approach to wealth creation? And then finally, what are your true priorities in life now, 5 years from now, 10 years from now, and long term? You really got to talk about these things with your spouse, with your family, and do an audit about all of these things before you take that major decision. Because a lot of these decisions are multi-million-dollar decisions. They're illiquid, and oftentimes they involve personal guarantees. So you cannot back out. You're in it for the long haul. So now switching gears, and now I would like to talk a little bit about not about how to get started in real estate or how to get started in multifamily. We've done a few webinars on those topics. If that's something of interest, I'm happy to share those links. But really what we are seeing in the market today when it comes to multifamily real estate and how we are changing our strategy when it comes to multifamily real estate investing. And some of this could apply to real estate in general, but this is our strategy for our market, for type of assets that we do, and for our priorities. Like our priority is risk-adjusted return for investors and not do high-risk deals that could potentially give higher returns. So we did a webinar a couple of weeks ago where we captured some of this. Some of you may have seen that in that webinar. So this would be a little bit of a repeat, but if this is something new, then hopefully this is helpful. So what we are seeing today in terms of market cycle is that rent growth definitely has slowed down. Midwest is still seeing decent rent growth. So that's all of Midwest and some of the Eastern markets too. So Ohio, Pennsylvania, Indiana, Kansas, all of these states are still seeing about 2 to 4% rent growth. And that is typically what we see in these markets. The rent growth is pretty stable. Even in hotter times, it's about 7 to 8%. So we never saw 20% rent growth that Austin and Phoenix once saw, but we are not seeing negative rent growth as well. But overall, as a US multifamily market, rent growth has significantly slowed down, has flatlined, and has gone to negative in some markets. There is affordability crisis. You may see S&P 500 reach new limits every day, but it is very deceiving because reality on the ground, we see our tenant base every day. On the other business, I see my consumers trying to buy these projects from us, home improvement projects from us every day. And people are not looking to spend. Everybody is so worried about their finances. It comes from a lot of uncertainty in the news as well, but also people are not doing as good. Their salaries are not increasing as quickly, and it's not keeping up with the inflation. So affordability crisis does increase delinquency risk in Class C neighborhoods. So we have decided to kind of stay away from Class C neighborhoods. Because if recession does happen, you can have up to 40-50% of your tenants delinquent. And then that leads to eviction prices, turn costs. It can basically bury you. ROI on renovations has reduced because your holding costs are up. So insurance has gone up, taxes have gone up, your mortgage has gone up with higher interest rates. So while you're holding that unit during renovations for that 1 month or so, you're paying for all of these things, which are your holding costs, and that have gone up. But at the same time, because of reducing rent growth, your ROI on renovations has actually gone down. So it's not making a lot of sense to do deep value add renovations anymore, because we were getting anywhere between 25 to 30% ROI on renovations for deep value add. Now we are seeing that number is down to 17 to 20%. Not a bad number, but the juice is no longer worth the squeeze, right? So if you can buy a turnkey asset that cash flows day one, that's a much better approach than having to flip the entire property. Cap rates have decompressed or expanded, which means your valuations are coming down. So even if you're doing your best to increase that NOI, your cap rates have decompressed, so your denominator is going up, which is bringing the valuations down. So there's that one aspect that you cannot control, and that's completely market dependent, which means you may have to sit on that property for some time. That era of flipping multifamily properties in 2 to 3 years for quick profits, that is over, right? Because everything's up, profits are down, interest rates are up. We all know that already. So it's a time to buy. I think it's still a time to buy. There are some price corrections that we are seeing in the market. There are good opportunities. There are more and more people looking to sell the properties because they have realized that for the next few years, there's no upside. So there's no point sitting on the property if they have already realized their business plan. So those are the people who are selling in Midwest. I don't see blood on the streets yet. So it's not distressed sale, but some people are selling it because there's just not enough upside for them in the next 2 to 3 years. So more deals to buy. So I think it's a good time to buy, but it is a good time to buy for long-term holds. 7 to 10 years is typically what we should be holding these properties for. Just a few charts. Declining rent growth. This is coming from CoStar or apartments.com. You can kind of clearly see significant decrease in rent growth throughout the US from 2022 through 2025, going from 8.2 average for US to 0.9% average now for US. And then this slide, I'll share the slides with you all as well, but this just shows the markets that are still seeing good positive rent growth and the markets that are seeing negative rent growths. So some markets that probably you should stay away from or only buy if you're getting really a good deal. Some of these markets are the markets that were really hot a few years ago. And of course, there's always going to be some sort of correction, because if the rent growth was 14 to 20%, it's not sustainable. So it's going to come down. So you can see that happening with Phoenix, Austin. So Texas, Arizona, Florida markets, you're seeing some of that happening. But with Midwest in this list, you can kind of see Indy, Columbus, Kansas City, a lot of the Midwestern markets. And that's basically for the same reason. The rent growth never was crazy high here, and it will probably never be crazy low here. Here you were able to reap those profits when the rents went up, but now it's kind of slowed down. Next, just overall interest rate comments. Interest rates, the federal funds rate did come down from July 24 through 25 by 1%. So that was a relatively sharp cut. But you can see the corresponding result in 10-year treasury yield. It came down here, went right back up. And there are many factors for that. As federal funds rate plateaued, people noticed, markets now know that they're not cutting any further. On top of that, a little bit of a weakening faith in the US dollar. So China, Russia, China, Japan, the big buyers of US Treasury are not buying as much. So you have to keep the yields high to make the Treasury lucrative enough to buy for people, the Treasury bonds. So multiple factors. So even if the jobs report recently was pretty terrible, so we will see most likely, I think there's like 82% chance rates are going to come down in September. But again, that's federal funds rate. And we don't know if 10-year treasury is going to come down significantly. Most economists, whether they are Wall Street economists or real estate specific economists like John Chang, Jason Hartman, all of these people, almost all of them are projecting that interest rates are not significantly going to come down and they're going to pretty much hold steady. So what does that mean and how does that tie to our goals? So our goals is number one, to protect investor capital and protect the equity. So even if the returns are slightly lower, the number one goal is to protect that capital. Number two is to, of course, maximize the risk-adjusted returns on that capital, not necessarily provide the best or highest return, but also look at the risk that comes with producing that return. Again, some of this stuff I've learned through experience and lessons learned. We have done deals where it was down to the studs. Alex was one of the investors on one of those deals, 17 units down to the studs. On paper, infinite returns. No matter how conservatively underwrite, infinite returns. But reality is always different. With these value-add deals, a million things can go wrong. And even the things that you never even imagined can go wrong, right? So you have to be cognizant of that and see what impact it's going to have on your returns. So buying a turnkey property typically reduces that risk and provides a little bit of a risk-adjusted return. Invest for the long term and appreciation rather than short-term gains, because it's much more difficult, again, to get those short-term gains in today's economy. Scale slowly, thoughtfully, and conservatively, which means long-term holds, and operate them right. And then just provide exceptional service to our tenants, because they are the ones who pay our bills. So that is really, it should be the number one on this list. So with that being said, what does that mean for our strategy? We are targeting really only Class A and B assets. And what does Class B asset mean? It does not mean 1980s and newer for us. Our definition is, even if it's a 60s asset, but all the work is done where they've got new roofs, new gutters, new windows, all the deferred maintenance is addressed, it is technically a Class B asset because maybe it's renovated in 2000, something like that, right? So as long as the property condition is Class A or B, and if it's in Class A or B neighborhood, that is really the type of asset that we want to go for with a 7 to 10 year hold. What this does is probably it's going to give you kind of mediocre looking returns, but more predictable returns. And it reduces the risks stemming from heavy renovation. And being in Class B, A or B neighborhoods also reduces the risk of being in a neighborhood where your tenant base is extremely challenged from the affordability crisis. B would be a higher emphasis on value add through operations because it doesn't cost us money to put better systems and processes in place rather than depending heavily on value add through renovations because that value add is a lot more expensive. Consider value add deals. Now, again, all of that being said, it's not like we will never even look at a value add deal ever again. But if you're looking at a value add deal that needs heavy renovations, the price has to justify the amount of work needed. So if we can buy something for under 60 a door in a Class A neighborhood where the rents are like 1,200, 1,400 plus post renovation, yeah, then it's still a pretty decent opportunity because again, you're getting much better ROI on those renovations. Then it's worth considering. Focus on cost basis and purchase price versus replacement cost rather than solely focusing on day one cash flow. Now, like I said, it has to cash flow day one. So if it doesn't cash flow, we won't be looking at that property. But a deal that cash flows at 10% day one probably has a lot of hidden bodies in the closet. So you want to buy a property that cash flows decent enough, but is relatively turnkey and does not come with the extra baggage and the risk from all the work that you have to put in. And then cost basis versus purchase price or replacement price is essentially if you're buying a property at 100 a door, but it takes 225 a door to build that property in that neighborhood today, then you're still getting it for a pretty good cost basis. And that's typically the reasoning that private equity and family offices use. Like, are they getting a good discount on the property based on today's market rather than just looking at cash flow? Because when you hold the property for long enough, you are going to get that appreciation in a good market. As an example, if you're a cash flow investor, you will never be able to buy Empire State Building in New York because you'll almost always have to overpay. Who will buy Empire State Building? It's going to be private equity. They will overpay for it. They'll probably not even get 1% return on paper on it, but they'll hold it for 20 years. And you can just imagine what's going to happen to value of Empire State Building in 20 years. It is going to go up. It's a trophy asset. So they will make money on it that way through appreciation. And that's what a lot of the really big investors do. And it's important to also take a look at what is their strategy and see how we can match the value add investor mindset with that long-term wealth preservation and capital growth mindset as well. A greater focus on long-term appreciation and equity multiple rather than just short-term cash on cash returns. So really that's kind of become our guideline now moving forward, at least until 2026. You know, if the market becomes really favorable again, it becomes a little easier to stomach some of those risks that come from renovation. But at least for now, that's kind of what we are targeting. So maybe this applies to some of you people, maybe a little bit different in the markets where you're at, but just wanted to kind of throw that out there if it's helpful for everyone. So that was my last slide. So with that, just thank you for listening to me rattle over an hour. I really appreciate your support and patience. I'll open this up for questions. My contact information is right here on the screen. If there's if we can do a one-on-one call, I always love that. Love doing Zoom calls with people and getting to know people. So if we have not connected, you can use my Calendly link. That's my email. And if you'd like to invest with us, this is a form you can fill out. So next time we have an offering, you will be informed. We do have something coming up. I can't make it quite public yet, still working on the details, but it's going to be about 70 plus unit multifamily, turnkey, matches perfectly with our ongoing strategy and provides day one cash flow in a Class A neighborhood. But it will be a 506C. It will be our first 506C because of the amount of raise we have. We do want to have the ability to market this deal, which is why it's going to be 506C. open only to accredited investors, but also because we have a lot of other active investors on this call, I do want to let you know that SEC, I don't know how new of a requirement this is, but if you're doing 506B, the new SEC rule is you have to provide your 506B investors or non-accredited investors 3 years of audited financials for the business or property you're buying. So if you're not doing that, it is an SEC violation, just FYI. So, and asking for 3 years of audited financials from the seller, that seller is probably selling that property to somebody else. You know, they don't want to put in the work to hire an accountant and do all that work, right? So something to keep in mind. But yeah, I think
Jay, my friend, thank you so much for this. This has been so educational, so helpful. We appreciate you sharing your knowledge with us. I mean, this has been fantastic. Does anybody have any questions for Jay?
Thank you, Eric.
I'm sure somebody has something.
I have one.
Sure, go ahead.
Yeah.
So thanks, Jay. That was fantastic. And you have a way of explaining things very concisely, and that hits like very complex concept that hits very well to us. So thank you. So on the buying the businesses, what has been I guess the biggest reality check that hit the hardest for you, if you had to give us advice there?
That's a very good question. And I would say, and thank you for that compliment, Jonathan. I would say two things. One, I think everybody knows that, but we end up forgetting it sometimes. Quick money is a myth. No matter what you do, there is no quick money. Buying businesses, again, like I said on this call, I don't want to be a Debbie Downer. It can be an incredible tool for building long-term wealth, but you got to have a 10 to 20-year horizon in front of you. You know, if you're trying to build a business with a 5-year exit, usually it doesn't work. It takes a long time and commitment. And two, I think you got to have a realistic expectation of the time commitment needed. So I'll be honest with you, real estate is my main gig and always will be. So which has caused a little bit of ignorance towards my other business. And I cannot flip it because we have investors on our real estate deals. So I will always have to fully focus on real estate. But what that is resulting in is a little bit of ignorance towards my other business. And I know if I had all the time, I could have very easily increased my current profitability and revenue for my other business. So time commitment, how much time you can allocate. And if it's not your time, do you have someone on your team who is really solid, who can invest their time, which means, of course, your equity gets split, but then you have a solid rock star where you're really betting on the jockey rather than doing the work yourself. I think those two were the biggest realizations that I had. Yeah.
Anybody else have any questions for Jay?
Yeah, I'll just say something that Jaideep brought up that it's I think is key to everything, right? So Jaideep, you mentioned that you started a franchise, right? And at least you had some sort of guidance. But if you're going into purchasing an existing business, it is key to get guidance from either one of the consultants that you were talking about or somebody that you trust 100% that knows about that business, because you just don't know what you don't know. So you're flying blind. So and again, I want to thank you. I agree with Jonathan 100%. You have a way to articulate stuff that's very easy to understand, and we really appreciate your time. And I think you dropped some excellent information today. Thank you, and thank you, Eric and Alex, for putting this together. Awesome call.
Of course.
Thanks a lot, Sip.
I have another one, if it's okay.
Yeah, go ahead.
So, I'm curious to know, to hear your opinion about the new executive orders that Trump did relative to the 401ks. So it's going to unlock like $9 trillion of 401ks to be able to invest in private equities or like real estate assets. Like, how do you see this playing into like those two fields of buying businesses and multifamily?
There's definitely going to be a lot of capital moving to buying businesses and multifamily. Our job as operators would be to educate our investors that this option is available. And then for investors, it's important to analyze their risk appetite, right? If they're getting close to their retirement age, is it worth keeping their money in S&P 500 and index funds that have shown a history of 10% returns, almost guaranteed, right? Of course, if the market tanks right when you retire, you may have to hold off until it recovers. But that's one assumption, right? And then as an investor, you definitely need to think about it. But at least it will unlock a portion of a lot of these 401ks to now flow into real estate, which most people, I think, agree and know that real estate can be a really powerful tool for wealth creation. But most people just don't know how to get started. And or some people don't have enough liquid capital, but they have a lot of money sitting in their 401k. So this can definitely be a really good change. But I think our main goal is going to be educating investor that at least that option is available. So, yep. And even 100% bonus depreciation coming back, right? So, I mean, one comment I would make is like, economy, I think, is definitely softening. We should be kind of watchful for that. There are some cracks we can see in the economy. The job reports kind of clearly was evidence of that as well. And tariffs is going to add even more uncertainty to that. The impact of tariffs, we still don't know. So I think that it's going to get harder and harder for younger people who are just starting out their lives in America. Like American dream is getting a little bit out of reach for a lot of the younger people. Like when I started, I bought my first single family home immediately as soon as I graduated. A lot of people in the past, in 70s and 80s, were also buying cars and houses immediately after they got a job, and they had all these perfect lives, suburban life. Now the new generation is finding it a lot hard to do because the starter home that I bought for 250K is now 600K, and I bought it at 2.37% rate of interest with a $1,500 monthly payment. That's over $6,500 in monthly payment today. And salaries have gone from 65K to 75K for a starter salary. So that's gone up by a minuscule level, while expenses have gone up way more. So I think unless you yourself, and if you're not teaching your future generation to invest in assets, they're going to have a big disadvantage because you can't beat the system. The only way to do it is invest in cash flowing assets. Only that can help you grow your wealth. Other than that, if you're only relying on your W-2 income, you're always going to be behind the curve. That's how the system is built. We can't change the system. We just have to find a way to play in it. So
Hey, JD, I have a follow-up question to Jonathan, actually. So if all of this capital could potentially be flown into real estate, do you see that now it's going to not artificially push the price up, but continue to hold that price up? So it's going to keep the returns down for investors.
that's hard to predict because there are some downward forces at the same time. Now, all this new capital now that can flow into real estate, and then the bonus depreciation coming back will definitely have more money flowing towards real estate again. Because you may have seen, like, as soon as bonus depreciation was beginning to go down to 40% this year, there was more and more money going towards like car washes and paving funds and business like funds, because the depreciation you get when you buy a business is better. But now you can see some of that capital moving back to real estate as 100% bonus depreciation is coming back. So I think there are market forces going in both directions. So it's very difficult to predict. Personally, for me, and even a lot of the economists I listen to, their message keeps changing every month. So it's like, because every month, honestly, Trump, hate him or love him, is doing something new every month, and that changes the markets, right? So most of the stuff is good for investors, and it's good for people like us. I cannot say the same thing that it's good for everybody in the economy. It definitely hurts a few people. That's just the reality. I don't want to be political, but at least if you have assets and you're an investor, most of the stuff that's happening is going to help you. So yeah, I think we will see a little bit more flow of capital towards real estate with all of these changes.
Can I add a couple things to that as
Yeah,
well?
absolutely, Michael.
Yeah, so I agree that the amount of capital that's going to be going into real estate but there's going to be a lot of it that'll be focused onto industrial and commercial real estate with everything that's going on. It's taking so much capital for all of the utility infrastructure upgrades that are supposed to be coming. I mean, the whole country has to be redone basically and upgraded to do that. So there's going to be a lot of the cash going to industrial assets, power plants, data centers, things like that that are taking more capital than has ever been seen before. So I think it's going to matriculate through all real estate asset classes, but there is going to be a large portion that people are trying to push towards that side of the market. And then from what you were saying, from younger kids not being able to do the American dream, anymore because interest rates, because of house prices and everything like that. We're also mentoring a bunch of kids right now, and we're kind of pushing them towards plumbing, electrical jobs, mechanical, plumbing, electrical, because our estimates, I think within 5 years, they're going to be making, if they're good, they could be making over 200,000 up to $300,000 per year because
Yeah.
the need for it is insane, like something we never seen. So I think it's going to be great for multifamily. But there's, like you said, there's people that are going to get hurt. There's people that are going to be on both sides of it. But I think there'll be a large influx of money going that way. But we're trying to educate them to go take those jobs and then purchase multifamily real estate to offset their taxes, right? So that they can get ahead of the system in the W-2. So that was just my
Yeah.
2 cents on what's going on.
No, I think you're spot on, Michael. And our friend Robert Musso, who's on the call, he's the expert in industrial real estate. I don't watch that asset class as closely as he does. I'm sure he's seeing some of those trends in industrial. And with AI, you're absolutely right. AI-proof jobs are getting more and more valuable. And then again, with AI, the need for computational power, industrial real estate is going to do very well as well because of that, because there's going to be more and more data centers. So, absolutely. Thanks for sharing that.
Awesome, Jay. Hey, thank you so much for hopping on, Jay. It's always a pleasure. And, at the beginning of the call, you mentioned that we've kept this call going for 2 years. And I looked back and I was like, oh, damn.
I didn't know that either.
I did not know
frankly,
that.
honest.
We're like a month or so away from cracking the 2-year mark.
Yeah.
Wow. So
Congrats,
that's awesome.
guys, on that.
Yeah.
Congrats.
That's
Thank
awesome.
Oh,
you.
geez,
Thank you.
thanks.
Man,
We love doing it.
Yeah.
So
I want to thank
It's
Eric.
a big
Eric's the
commitment.
one.
It takes a lot of time and effort to do this too. It's very easy to start something, and then after the 6 months of energy wears out, and people usually lose track of things. So really
Yeah.
appreciate you guys keeping this going, because this is a great way to connect with everyone on Saturday, and everyone has really good things to share. So it's a great free learning opportunity. So Alex, Eric, thank you for having me, and thank you for keeping this on. So really appreciate it, guys.
well, thank you, and thank you to all of you for making this work. Because if it wasn't for you, this wouldn't be happening. So we appreciate all of you every Saturday, second Saturday of the month. Alex and I really, really appreciate everybody's involvement and support for us and these calls, because really we're supporting each other and growing the family.
100%. 100%. All right, guys. Thank you guys so much. Happy 2 years.
Yeah. Great.
We'll see you
Thank
guys
you all
on
so
the
Great
much.
next
weekend,
one.
Thanks,
everybody.
everybody.
Thanks
Jay,
a lot
thank you so much
Jay.
again, my
Thanks,
friend.
Enjoy your
everyone.
weekend.
All
Thank you
right.
all.
You guys
Thank
rock.
Jay.
See you guys.
See ya.
Thank you. Bye. Thank you.
That's a wrap for today's 911 real estate call.
Thank you so much for attending, sharing your thoughts, and learning with us today.
Real estate isn't just about numbers, it's about creating intentional moves and finding opportunities that align with your goals.
Whether you're saving lives, leading a business, or growing your investments, the goal is to make your money work for you.
Stay engaged, keep learning. Let's keep pushing forward towards financial freedom.
We look forward to seeing you on our next call.
Until then, stay focused,
Stay connected and keep building wealth
one property at a time.